Initial paperwork shows that Lyft is not profitable, has no plans to be profitable, and are we going to be holding the bag at the end of the day? It's a very interesting discussion to be had, and this will probably be a fairly long one, but before we have that discussion, how about a word from our sponsors?
And today's video is sponsored by Maximo, the rideshare automation app that allows drivers to safely and easily accept ride requests for Uber, Lyft, and Postmates. Whether you drive for a single platform or multiple platforms, Maximo's custom settings can help you drive more efficient, less distracted, and help you maximize your earnings. It will automatically accept one trip, turn off the other apps, and when your trip is over, it will end it, open the other apps, and accept the next trip, all without you having to touch your phone. Use referral code APP60 and get your first month free when you subscribe to Maximo.
Hey everyone, this is Kevin the Apptrepreneur, and if you've been watching me for let's just say a month. I mean, it should be several, but let's just say it's about a month at this point. Then you know that Uber and Lyft are not profitable. I hammer this on over and over again. I bring it up as often as it is appropriate, because in my opinion, it is always appropriate. Because we need to discuss the elephant in the room. A company that does not make money, that is not profitable, will shortchange people somewhere along the line. Uber and Lyft for a decade have been living off borrowed time. They have literally been borrowing money to line their pockets as they build a business model that we don't even know is going to work. It is also appropriate that I start talking about Netflix and Spotify, because those are a couple other companies that for years have become wildly popular products that everybody loves and everybody uses, and yet very, very unprofitable. And they don't know how they're going to make money at some point either. We want to throw away the old methods of how we used to do things for methods that are more convenient, but which offer very little financial gain. Take, for example, and I've got to lean over real quick to pick this up. I am sorry for the close-up. The DVD market. Well, this is a 4K and Blu-ray 3D, but you know. The bottom line is studios are trying to move as far away from these as possible. They're trying to, and Netflix is even trying to move people away from the theatrical experience, because digital is more convenient, it's cheaper, supposedly. But here's the thing. When you sold millions of these, you made millions of dollars. When millions of people stream your movie, you're not making any money off that. They're just paying a flat fee, and they could use that flat fee to watch 1 million movies if they want. Which means, why are you trying to get to this when it still makes money? And that's where we talk about Lyft. Because Lyft's IPO disclosure shows it's not close to profitability and has no good way to get there. That headline alone should scare you if you are a Lyft user, driver, or work at the company. Let's look at this. So, investing mavens who think of the big ride-sharing companies Uber and Lyft as the next big opportunities to get in on the ground floor of a fabulously profitable stock must have been downcast by Lyft's financial report in advance of its pending initial public offering. At least one would hope so. The IPO registration statement made public on Friday revealed something that smart followers of this supposedly disruptive new technology have known for years. Lyft is deeply, deeply in the red, and it has virtually no prospect of turning profitable anytime soon, if ever. Now, let's pause for a moment, because I have known that they have been unprofitable for a long time. I have not had any access to statements. They have just been very upfront about this. I read the statement, and I do not have the ability to properly explain it, but it looks really grim. It does not look like there is a path to profitability, which begs the question, why would any sane person invest in them? Which I know some of you are going to say, well, Kevin, you're going to invest in Lyft and Uber. Well, I've been very clear. I'm investing in them just to give me an excuse to continue to talk about them, because people keep saying, like, why don't you drive? If you're not driving, you shouldn't be complaining. Well, you know what? I'm going to be an investor, so that gives me my right to complain. But I have no illusions that I'm going to be throwing my money away on those. But let's continue. In fact, its future resembles the old joke about a business that loses money on every sale but hopes to make it up on volume. There's no reason to expect Uber to look any different when it makes its own IPO disclosures expected later this year. Uber is bigger than Lyft, but otherwise it's in the same business. By the way, this was a quote from their IPO disclosure. Our mission, improve people's lives with the world's best transportation. Yeah, best transportation, which is rundown, wonky cars with drivers that have no experience and get paid crap. Yeah, world's best transportation. Whatever. This is what you put on a limousine company, not on a rideshare, but whatever. Quote, they're a staggeringly unprofitable company, says Hubert Horan, a transportation expert who long has been a critic of the Uber and Lyft investment pitch, with nothing in the document that suggests how that could be fixed. I mean, nothing. The excitement generated by the pending IPOs of these two companies is fascinating because it seems to point to all the pitfalls of investing amid an unwarranted frenzy. Lyft is expected to be valued at $20 billion to $25 billion after its IPO. Uber's promoters have been talking about a valuation for that company of as much as $120 billion. These numbers would be extraordinary for a profitable company going public, but especially so for firms that have never turned a dime in profit. What they do offer are stories in which the global transportation system is about to be dramatically remade, with them as the beneficiaries of disruption. People will no longer own their own cars, but will rely on those of Uber and Lyft drivers to get them where they want to go. Or not drivers, actually. In 2016, co-founder John Zimmer spun a fantasy, I love how they called this a fantasy, on Medium in which driverless vehicles would account for the majority of Lyft drive rides within 5 years, i.e. 2021, 2 years away. It's always 2 years away. For backup, he cited Tesla CEO Elon Musk, whose own ability to turn his own fantasies into reality lately have come into question. Zimmer went on to assert that private car ownership would all but end in major U.S. cities by 2025. Do you think that's plausible? Me neither. Lyft still talks this way. In a section of its IPO entitled Why Lyft Wins, it says that in the future, fleets of autonomous vehicles will unlock a new mode of transportation, presumably with Lyft at the wheel. Lyft fills in the gaps with airy claims to a higher purpose. Our mission, it states in its registration, is to improve people's lives with the world's best transportation. One would think its mission would be to make money, but since it doesn't do that, it might as well lay claim to a goal no one can measure in dollars and cents, which begs the question, how can you put a dollar amount on this stuff? What's often let out of the narrative of world-changing innovation is that the pricing of Lyft and Uber rides is largely fictional. To the extent fares produce losses, those losses are eaten by the venture capital investors who have kept the companies afloat to the tune of $24.2 billion for Uber and $4.9 billion for Lyft, according to Crunchbase. But the companies are planning public offerings now because the venture investors are agitating for an exit door by shifting the business risk from themselves to public equity investors. And this is where investors really want to pay attention. Well, this and the next article, because we actually have to discuss 2 articles in this one. That's why this video is going to be so long. Those investors, however, are seldom willing to donate alms to customers. That suggests that once Uber and Lyft go public, they'll have to squeeze not only their drivers, but their passengers for more money. Fares will rise, their competitive advantage over taxis or public transportation will shrink, and the fundamental economics of their business will change. That brings us back to the here and now, in which Lyft's business consists of bringing together passengers with drivers via a smartphone app. The drivers aren't considered employees, but independent contractors who are responsible for their own gas, insurance, and wear and tear on their cars. Like Uber, Lyft establishes fares, sometimes unilaterally, offering passengers discounts and collects a commission on each trip. In financial terms, the result is ugly. It is absolutely ugly. There it is. This is the Los Angeles Times. This isn't some crackpot conspiracy theory website I've cooked up and No, this is the LA Times. And by the way, people love Uber and Lyft here. Just saying. In 2018, Lyft lost $911.3 million on $2.16 billion in revenue, which was its share of the $8.05 billion in bookings. That is fares collected by its drivers. The previous year, Lyft lost $696.1 million on a revenue of $1.06 billion. Its share of about $4.5 billion in bookings. That's an improvement in a sense. Lyft's revenue more than doubled, but its loss increased by only 32%. Only 32%. By the way, I love how they added this. Is the world ready for driverless cars? Are driverless cars ready for the world? That's a separate article. Maybe we'll make a video on that. Who knows? But it doesn't betoken a path to profitability, in part because the improvement reflected an intensified squeeze on drivers. As Horan calculates, the driver shares of bookings fell to 73% in 2018 from 77% the year before, and from 82% in 2016. By his reckoning, if the drivers had only retained their 2016 share of bookings, they would have collected an aggregate of $941 million more by 2018. Instead, that money flowed to Lyft's bottom line, reducing its losses. That suggests that, quote, there will be very little potential to use even deeper driver pay cuts to improve unit economics going forward, Horan argues. There's only so much it can wring out of its drivers. And let's pause for a moment here before we continue, because we need to pivot for a moment on where this especially rings true. Everyone know that mass multimedia network Machinima. Machinima had PewDiePie, and then they didn't after a while. And they had like things like Red versus Blue. They had all of these content creators that they would put under a network umbrella, and they would promote these content creators to other companies, and they would collect a percentage. Essentially, they weren't doing a whole lot of work. They were just collecting money. Disney at one point bought them for a little more than $500 million. And they looked at what the assets were, and there wasn't anything there. All of their content creators were independent contractors, which meant once their contract was up, they could leave. There was no negotiating. They had no assets, and Disney was left holding the bag. And then you start seeing other companies like Defy do that. In a sense, that's very much the business model of Uber and Lyft. They are collecting little fees from you and me across millions and millions of people. You would think that that would be profitable, but it's not. And they have no assets. So I predict that, maybe Google or something might try to buy them and apply to their own self-driving cars. Maybe Tesla, who knows? But the self-driving cars have to be there. And otherwise, there's nothing here. Let's continue. A couple of other items in the Lyft IPO statement should give investors pause. One is the supermajority control that will vest in the hands of its co-founders Logan Green, 35, its CEO, and John Zimmer, 34, its president. Neither has ever run a profitable public company, but the IPO will grant them shares with 20 votes each, while members of the public get shares with only 1 vote apiece. Now, here's one of the things to remember. During that whole Travis Kalanick thing where I was like griping about him pretty much every week, he had super votes. That is why it took so long to get rid of him, because his super votes counted for so much of the public voting that essentially the whole company had to turn on him before we had a chance to get rid of him. So keep that in mind. That means that Green and Zimmer will be able to, quote, significantly influence any action requiring the approval of our stockholders, even as minority shareholders themselves. To put it another way, these two 30-somethings will have no incentive to listen to anything that might fall into the category of constructive criticism. These supermajority arrangements cementing founders in place have been popular among tech companies such as Lyft, but they've acquired a foul odor recently, due in part with the experience of Snap, the app company run by a couple of 20-somethings with unassailable authority. Snap, which has been chasing its own tail lately, closed at $24.48 on its IPO day in March 2017. On Wednesday, it closed at a princely $9.87. Then there's Facebook, where founder Mark Zuckerberg is similarly ensconced with impregnable control and has been using it in recent years to drive the company's reputation for trustworthiness into a ditch, which I agree with. The only reason I haven't talked about it as much is because I'm trying not to talk politics on this channel, if you know what I mean. Green and Zimmer each received salaries of $288,654 and stock awards valued at $41.7 million in 2017. The registration statement says Green received $400,000 in salary, but no further stock awards in 2018. It doesn't mention Zimmer for technical reasons, but his compensation is thought to be the same for 2018. Green received $935,105 last year for personal security services, which has produced some raised eyebrows among securities analysts who can't imagine what would warrant such expenditure. It isn't clear whether Zimmer got a similar outlay. Lyft wouldn't discuss security spending on the record. None of this means that Lyft might not have a successful IPO, defined as luring enough investors into the pool to make a splash on a multi-billion-dollar valuation. If that happens, Uber is likely to do even better. But it's inescapable that the ardor for these companies is based on their stories more than any hint of financial promise. Quote, "The one thing these companies are good at is manufacturing narratives," Horan says. If Lyft fails to make good on the prospect of limitless growth and profits, as it acknowledges might happen, buyers into the IPO may well wonder why they bought. I think they wanted to put an "it" at the end there, but oh well. If they've read the Lyft registration statement, at least they won't be able to say they weren't warned. And here's where we're going to pivot to this other article. And I don't normally do 2 articles in one video. That tends to be a lot, but I think this is a really good companion piece article. And just in case my fat head is obscuring some of the headline, it says Uber and Lyft are losing money. At some point, we'll pay for it. This is an opinion piece, by the way. And it begins, legend has it that in 1929, businessman Joseph Kennedy, the father of the future president, realized it was time to get out of the stock market when the shoeshine boy started offering him trading tips. I had my own such moment a couple of years back when I started hearing people say they were selling their cars because, quote, "it's cheaper to take Uber everywhere." It wasn't that I doubted them, mind you. I just started to wonder about the math. Uber and Lyft are functionally taxi cabs. Better dispatch and more convenient, but still taxi cabs, pretty much. There's a reason that before the Uber-Lyft revolution, almost no one said, "I'm going to sell my car and take taxis everywhere." Unless you are a hermit or live in a dense urban core, a month of taking cab costs more than a month of a Corolla ownership. Boosters of the rideshare revolution like to point out that most of the nation's cars spend most of their time parked. There ought to be money in liberating all that unused capital. True enough, except that someone has to drive the car, including the time spent circling it as they wait for rides. In 2014, journalist Timothy B. Lee spent a week driving for Lyft. He drove for 50 hours, so spent only 14 of those hours actually ferrying passengers. Clearly not a very experienced driver. All that circling wears out the car and burns both gas and the driver's valuable time. Lee might have gotten better at optimizing his rides. He driven for longer, I guarantee he would have, but still those costs remain considerable. So how can Uber and Lyft, both of which are planning initial public offerings this year, be price competitive with car ownership outside of places such as Manhattan? Answer, heavy subsidies from both the companies and the drivers themselves. Uber and Lyft have long used investor money to subsidize operations. Lyft's IPO documents filed last week indicate that in 2018, the company booked $8.1 billion in rides, collected $2.2 billion in revenue, and lost more than $900 million after expenses. Uber is also losing money, although perhaps not quite as much. Actually, even though they have a link here, I'm going to say Uber is probably losing considerably more. This, despite the fact, I'm sorry, my nose itches, that many drivers seem to be underpricing their service. Whether a driver arrives to pick you up in a massive truck or a luxury mobile, you're either looking at a driver who took up driving as a form of charity work or one who doesn't understand that ride-sharing income should be calculated after deducting gas and vehicle depreciation. Not every driver makes quite such a blatant error, but there's considerable evidence that earnings are low after accounting for expenses, and drivers don't necessarily realize that. I fully believe this is the case. Because when people look at the app, they see, oh, I made $238, not realizing, yeah, there's about 115 of that you got to take out. You know, whether it be for taxes or gas or maintenance, whatever. Thus, the ride-sharing market offers a real-life illustration of the old economist joke. We're losing money on every unit, but we'll make it up in volume. Unfortunately for us riders, there's only so much cheap investment money and only so many inexperienced drivers out there. Once Uber and Lyft have burned through those, they're going to have to charge us what the rides are actually worth. Customers will be in for a rude shock. Nor are theirs the only customers due to relearn that there's no such thing as a free lunch. After 13 years, the music streaming service Spotify finally and barely turned a profit last quarter in its nearly 100 million subscribers, only to forecast substantial losses for the coming year. Netflix is burning through borrowed cash as it races to build out its content library. In the journalism business, a host of digital startups are running out of investment funds without ever having run into a viable business model. That's not to say that all subsidized businesses are headed for the same kind of trouble that has beset BuzzFeed or the Huffington Post. There's obviously a market for ride sharing, for streaming, and yes, even for digital journalism. And in some of those businesses, notably streaming, the massive economies of scale really might deliver Facebook-style windfall to early investors. But Lyft and Uber are a different story. They're not selling a song or a movie that can be endlessly replicated for a little incremental cost. They're selling a physical service that's pretty expensive to deliver. At some point, we're going to have to pay for it. Heavy users of ride sharing should start getting used to the idea of that the cost will soon go up and plan their lives accordingly. And investors should prepare for demand to drop when customers and drivers discover the true price of the service. In other words, as modern day Joseph Kennedy might say, don't buy frothy stocks unless you're willing to lose a bundle, and don't sell your car unless you're willing to walk. This is the future of rideshare, folks. Why are they going public? Because they are running out of ways to raise money without going public. Also, it's a pride thing. One company decided we're going to do it, and now everyone has to do it. Now Lyft is going public. Pinterest is going public. Postmates is filing to go public. DoorDash is going public. All these companies are going public. None of them make money. But what they are hoping is that they will raise millions upon millions of dollars to keep the services going long enough for them to figure out a business model. I'm kind of reminded of that scene in The Social Network, which is ironic because Facebook did become very profitable. But it's an ironic scene because Mark Zuckerberg is talking to, I think his name is Eduardo. I think that was his friend's name. If not, it was Andrew Garfield's character. And Andrew Garfield, who is the manager, says, okay, the site's up, it's popular, we need to put ads on it. And Zuckerberg says, no, we're not going to put ads on it. It's like, well, how are we going to make money? It's like, we got to make money. It's like, well, we don't know what this thing is. We don't know what it can be. We don't know why people are using it. What we do know is that it's cool, and we don't want to ruin that by selling Mountain Dew ads. But the thing is, eventually ads became Facebook's bread and butter. Yes, they sustained heavy losses, and advertising became their thing. Now, I know Uber has talked about advertising. I have made videos where I doubt just a little bit if that's going to be a real thing. But the thing is, it needs to happen soon. The driverless cars won't save Uber. Heck, the initial investment in the driverless cars are going to be so staggeringly high, Uber is in for a sticker shock once they have to maintain the vehicles themselves. As this article pointed out, once you burn through the good drivers, then you have to pay them what they're worth, because you don't want a bunch of crummy drivers using your service, which both services are really close to doing. Heck, so much so that we have got, I think there's at least a dozen Uber tubers that I watch, and only one of them drives for any substantial amount of time, maybe two. And you know, and one of them's doing it just for content for the YouTube channel, because that's not even, Uber's not the main business anymore. So these companies are in trouble. Investing in them, I couldn't in good conscience tell you to do that. Again, my personal reason for investing in them is so that I have a legitimate gripe with them, that I can legitimately complain about them every single time. And by the way, I'm not going to buy much, maybe 5 shares each. Who knows? Depends on what they're priced at. But these are money-losing companies, and again, as the paperwork for Lyft showed, they're not selling their company on making money, and their report shows no way on how they're going to get out of the financial hole they've caused themselves, or they've dug themselves into. It's going to be a very interesting observation to see what happens with these companies when all is said and done. But hey, Now that we've been rambling for about 25 minutes, what says you? Do you agree? Do you disagree? Are you one of those people who sold their cars to take Uber and Lyft everywhere? What would you do if that $5 for ride to work turned into $15 suddenly? What are your options then? I would love to know. So comment below. Like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, of course, but even as little as $1 a month goes a long way to helping the channel run smoothly, and you get access to my Patreon's exclusive blog. And as always, flame responsibly. Have a good one.